Hey everybody, welcome to this free edition of our Trading News Group Weekly Roundup with the trading weekend in April 29th, 2022. I'm President Brent. Thanks for tuning in. Well, this week's theme is clearly apropos. I think the markets were clearly taken to the woodchopper this week. Very, very ugly week. Why don't we just kind of step inside, see what's going on and what can be happening over the next few weeks or so. We look, everything is in the red this week. I mean, the major indexes, all of them had the fourth consecutive week of losses. Dow is just shy of correction. S&P is in a correction territory. NASDAQ and Russell are in bear markets, even though the Russell is down 17.09% for this year. It was already down from the all-time highs. So both of them not doing that well. All right, not well at all. And as the markets go, this is the worst 4 months of the year of a start since 1930. Let me say that again. As markets go, it was the worst 4 months of the start of any year since 1930. NASDAQ's worst start since 1971. Really not a very pretty go of it. You can see the PE ratio. The forward PE is down to 18.62. I think it's going to come down a little bit more. All these revaluations, it's believe it or not, it's not a crash. It's just orderly revaluation of where the markets are based on forward guidance and earnings. That's pretty much about as simple as I can make it. The dividend yield is 1.46, Treasury 289. So the Treasury is 98 bits higher than the dividend yield, right? So we'll start to see money flow back into the bond market. That's why I don't think interest rates are going to get much more than 3 to 3.2 or something like that. Then I think interest rates will back off a little bit. Earnings yield over 6% for the S&P. That's assuming their earnings come forward. Now, the projections for this year, for 2022, analysts are saying the earnings are going to come in at around 228. Now, I've got on there 205, as you can see in the numerator on the earnings yield. But if they come in much better than that, we'll see the yield come down just a little bit, okay? Yield over the Treasury, 3.15%. The real yield still a negative 4.35 due to the very high inflation. Current VIX finished up for the week 18.4% from the prior week, 18.4% higher. VIX finished at 33.4. You can see even the best performer for the week was in the red. That was energy. Worst was communication services, down. Communication services kind of leading the way to the downside year to date. Energy's leading the way to the upside. Not much change there. Okay. Now, if we go into it and take a look at it, the economic data this past week, well, everybody was surprised. We weren't, but everybody was surprised that the GDP came in at an annualized rate of a negative 1.4. First pass of Q1 this year. I think the expectation was around 1% to the upside, so that was 2.4% worse than expectation. That also upset the markets. Consumer spending, however, was up 2.7%. The consumer is still spending like a banshee. Business investment was up 7.3%, well above expectations. So this underlying data suggested it may be still a little bit too early to conclude that this is an onset of a recession. Remember, recession is 2 GDP quarters of negative GDP growth. So we still got a long way to go for that. But we got to watch and see. And a big player in this whole mess is going to be the Fed. More on that in a minute. We did get year-over-year increase in core personal consumption expenditures, the PCE. That's the Fed's preferred inflation gauge. It came in at 5.2% in March. That was the first deceleration in over a year, by the way. Year-over-year headline PC measure, though, advanced to a 40-year high of 6.6. The difference is the one the Feds follow don't include food and energy, which to me make no sense at all, because to me that's where a lot of consumers are spending their money, is in food and energy. But you take that out, and obviously it cuts down. It's just the government's way of trying to manipulate data, in my mind. But that's kind of what we got there on some of the economic data that hit over during the week. Now, if we come in and we look at Treasuries. Well, Treasuries kind of ended the week where they started, all right? But the exciting thing is coming out this week. We're going to hear from Boom Boom Powell. We're going to get his anticipated Fed action to combat these inflationary markets. What's he going to do? There's a lot of options. The Fed Fund Futures is pricing in from this point forward an end rate of 2.75 to 3%. Okay, so that'd be about a 2.5% total rate hike between now and the end of the year, not counting this meeting coming up on May 4th. So that's a lot of rates. I've told our members, and I'll tell you guys here, I think the markets are pricing in a little bit more of a rate hike than the Fed's going to end up doing. I think they're going to come in. They may start off quick and aggressive, but I think they're not going to be as aggressive as the markets are expecting. And that's going to give the markets a little bit of a bounce in the month of May, right? But we'll know once we get through Boom Boom Powell's press conference at 2:30 p.m. Eastern Standard Time on Wednesday of this coming week. The other thing that everybody wants to hear, me in particular, is what he's going to do with the balance sheet. We got about $9 trillion. That was just total screwed up increase in the balance sheet. Why they ever did that is just beyond me. Okay, they're going to have to cut that back, and understand the anticipation is that they're going to cut back a $500 billion, $750 billion every year. And they do that for 4 years. That'll be the equivalent of another 210 basis point rate hike. So not only will he be hiking the rates, but he's also going to be doing an inadvertent hike by cutting the balance sheet. We'll see how much the markets like this. Like I said, I think the markets are not going to like it after a while, and he's going to be forced to slow down his rate hikes. Okay. That's a little bit about what I see in the U.S. markets. Show you the charts in a minute. If we come over and look at Europe, just kind of see where everything stands. You can see the only green, really, kind of an oasis of red, is the FTSE over in London. It was up 30 basis points for the week, up 2.17% for the year. Outside of that, everybody in Europe was in the red, not by a lot, but in the red. They're having strong earnings over there, so it's kind of helping offset the slowing economy and the war on their eastern front in Ukraine. Okay. But they've got very high inflation, and they've got the prospect of tightening monetary policy by the ECB. So we're going to see how that expands. Now, we did get Eurozone economy for Q1, and unlike ours, which contracted 1.4%, theirs expanded 20 basis points, 0.2%. Okay. So we'll see how that plays out. Inflation over there, like here, is very high. I think it accelerated to 7.5% in April. That's the highest level inflation they've ever seen inflation in Europe since the euro was launched. Huge, which would explain why the euro has crashed. I mean, the euro is down very hard. The dollar is up very strong. And we're just seeing a flight to quality here, and you're no longer seeing that in some common flight to quality currencies, i.e., over in the Asian markets, the yen. That's at like 20-year lows, because Japan is just really buying up all the debt they can with government money. They're trying to help the economy out. They're trying to keep their yield curve flat. All of that stuff is crashing the yen. Okay, their CPI is forecasting to rise to 1.9%, compared with a 1.1% that it indicated in January. So Japan may finally, after a couple of decades, get that 2% inflation number, which is what they've been trying for, forever. Okay. They also, by the way, downgraded their economic growth from 3.8 to 2.9%, basically saying the resurgence of COVID over there, rising commodity prices, and then just a slowdown in orders from Europe and the U.S. So they're having their issues. And then, of course, we got China, Chinese markets. They're having their zero tolerance policy for COVID, which I think is the biggest dumbass policy I have ever heard of. It's like trying to stop the flu. Give me a break. You know, they're causing more damage than anything else. But it's a totalitarian government. It's a communist party. They could do whatever the hell they want. I hope Xi just wrecks that economy. Right? He's going on. He's working on that. This will be his third term if he's elected this fall when the Politburo meets. We'll see how that all shapes out. Um, and I don't think China is as committed to Russia in the Ukraine as they are into stabilizing their economy. China's playing long ball, and they'll let Russia suffer if they have to. Right? China's more embedded in Western economies, imports, exports, and everything else. Russia really isn't. So I think China was kind of giving Russia, go be our pit bull, right? Let them go do it. And so, I mean, China's a lot. They run a little bit smarter than Russia anyway. So we'll see how that all shakes out. But meanwhile, that COVID is just really screwed up over there in Beijing, hangs out, Shanghai, month-long lockdowns. We're going to feel it in our supply chains in months. We haven't felt the full force of it yet, but we will. It's going to be very painful for everybody, right? So with that as a backdrop, let's go take a look at the charts. I just want to kind of show you where things are shaping up here. Let me just get it over here. It's not going to be pretty, folks. Like I said, our members, we're making money for the year. For those that are following what I'm running, especially PM accounts, portfolio margin accounts, we're making money this year. But just about everybody else is getting crushed. Can't pick the bottom in these kind of markets. It's too hard to do. You can see here, we've got an Elliott wave 3-leg down. That suggests we'll get a bounce. I think we could get a bounce in May, believe it or not, and then a rollover in June. We have not made new lows in the S&P. The last new low we made was back over here on February 24th. We're close, but we're not there yet. Okay. I do believe that we've got if we do take out this 4,100 level, I've got a pretty good solid area down here around the 3,800 level, which would be the next stop. All right. I don't think we'll get much lower than that. As long as consumers are spending and growth in earnings per share in the US, even though tech had a bad week, especially Amazon, we're seeing growth, right? Double-digit growth in earnings per share. So as long as that continues and the consumer continues to spend, I think we'll be fine. We're just going to it'll be a buying opportunity for a lot of long-term investors. So I don't know if we'll get down to that 3,800, but I do believe we'll kind of drift a little bit. We're going to get a bounce, and then we'll see where we go from there. Okay. And by the way, if I blow this up, you will see finally the 50 EMA is crossed over the 200 EMA in the S&P. It was the lone holdout, right? Every other index, the 50 had crossed below the 200. Typically, when the 50 crosses below the 200, you trade the index completely different than you do when the 50 is above the 200. Okay. That means you trade it like a bear market chart. Even if we're not in a bear market, you trade it that way and you flip the script a little bit. Members, that you understand what I'm talking about. We've talked about it over and over, right? And we'll spend some time on it again this Sunday evening. But we can make money in the markets if you understand how to play a bear market chart. If we come over and we look at, let's look at the Dow. It's probably the best looking chart outside of the, as far as drawdowns off the high, right? Even the lows over here that were made back on February 24th, it was only down 12.6%. We're down a little over 9% right now, but I think we can drift a little bit lower here. And if we look at the, let's come over here to NASDAQ here. Here we go right here. NASDAQ is ugly, very ugly with the NASDAQ. You can see here well below the 50 and the 200. We're coming up, getting ready to make new lows. We just made new lows in NASDAQ on the 26th, just 4 days ago. And now we're looking to take out those lows again. This was my target right here that I had on the screen for about 3 weeks. Down around 12.4, let's call it 12,500, right in that area there. And then I think we'll start to see some buyers step in. And the Russell is even worse, believe it or not. If we come in, here we go. Let's go look at the Russell. Looking at the Russell, we actually made new 2022 lows on Friday. Okay. Really ugly. Just ugly, ugly, ugly. So that's kind of where we're sitting on the major indexes, guys. I mean, it's one of those kind of things that's just, it happens. Normally the markets pull back 10% at least once a year. We haven't had a long pullback or drawdown like this in a while. Even COVID, it lasted about 6 weeks, but it was very fast. And then we came up very fast. This is a little bit different. It's a completely different market regime with rising interest rates, high inflation, slowing growth. You got to understand the market dynamic that you're in before you just start taking a trade. And that's the dynamic that we're in right now. Okay. So we come down here and look at volatility. See the VIX is up in the red here in what I would classify, as markets in correction mode. That's kind of where we are. We're over 30. Once the VIX gets over 30, we can see some market movement of 100 plus points up and down every day. Okay. You can take a 80 to 100 point positive in the green and give it all up by close, or vice versa. We could be under 120 points and close in the green at the end of the day. So it's a day trader's market if you understand how to get in and get out and manage risk. It's one of those kind of markets right now. Long-term investors, you just got to resist the urge. If you've got good stock and you like the balance sheets, you like what they're doing, earnings and growth, then you just have to stick through it. Okay. So it's a little bit about that. If we take a look at Treasuries, bond interest rates went up pretty good on Friday. Okay. You can see where we're sitting here, near the 2022 lows. This has been one of the best trades we've had all year. For directional purposes, trading the bonds to the downside, interest rates to the upside. We've been on this since 2 or 3 months ago, all right? Well, long ago, and we've made great money on it. It was a low-hanging fruit trade. It's back over here. Actually, it was in November of last year, right in this area here is when I was talking about getting short bonds or playing it to the downside, okay? And every rally should be sold off. This was another sell-off opportunity for people that missed this original down move right here. Okay? It's just a really interesting play. Currency-wise, well, the dollar came in just a little bit on Friday, but it was well extended, right? I mean, look at this dollar. It's coming up to the 2021 high. In fact, let me just take that off the screen just to get it up here like this so I can show you. It was near that like that. So now we're at about 103. 103.95 is the high, right there. You can just see it's a rocket ship. It will come down, guys. For those that have patience and want to play a longer term trade, I like shorting the dollar up here, right? But you can see any sell-off right now is going to be bought. We do not have any divergences here, so the odds favor it. A little bit of a dip, another run up, maybe make a new high, and then it'll give it up. That is the support point I see right around 97, 98. But the key to it is not going to be so much the dollar, it's going to be the euro. All right, look at the euro here. It was real ugly. And we actually went down very low. Let's get this here. Right like that. Down to 104.9, almost 105 in the euro. We blew through both of my resistance points or support points, which are now going to become resistance. All right. It's just an ugly chart all around. I mean, just very ugly. Some people think the euro is going to go to parity with the dollar. Right. I remember when that happened. I was over in Europe at the time that they came out with the euro. In fact, I was in the Netherlands trading the guilder, working with the guilder. And then when they came out with the euro, and they gave all the street merchants a couple of weeks to get rid of the guilder and go to the euro, it was a mess. But it all worked out. But now the euro is coming down pretty good. Where is it going to go from here? It all depends on where the Fed's going to react. But I think the big wild card in this whole game is Russia and Ukraine. Depending on what they do there is going to control the European economy. The Feds are going to control the U.S. and interest rates and kind of set the general tone. Okay. If we come down here and we look at gold, longer term, I like gold to the upside, but you can see this big draft down here. I like silver better than gold. Longer term, if you're willing to hold for 2 or 3 years, you can play that to the upside with gold. Now, we've got a way to trade gold and the other commodity, oil, and make some serious money on it. Okay. Members, I know some of our members are doing it. They're posting it in the chat room. They're posting their images of the trades. They're great trades, and they're simple to do. So we're going to stick with those trades, but I think longer term, both gold and silver will go up. It's better to be in silver and gold because on a return on capital basis, you'll get a better performance out of silver. And then, of course, if we look at energy right here, it's just going to run sideways. It looks like it's kind of forming, you know, a triangle, right? And the opportunity of a breakout is more upside break than downside break. But let's see what happens. The big risk in trading oil is if Russia and Ukraine announce a negotiated settlement, or they're close to one, you'll see oil come down $4 or $5 a barrel at least, maybe even more, right? Same thing with energy across the board. We'll see how that plays itself out. The other one that we've been long on, we've had a great play in it this year, is also next to one of our best trades outside of the bond market, is natural gas. We've been in nat gas. It's just been a beautiful chart. You can see the way nat gas has been moving up. Folks, that's what I want to see in natural gas. Small, daily, incremental moves higher. I don't want to see these big moves like that because then that's manipulation and it almost always comes back down. See these big moves, these big green bars, it gets very choppy. But when you get these really small bars and then we look at volume, you can see volume has gone up as we've moved up. As we pull back, volume comes back. That's the classic definition of bulls coming into the market, money coming in to the nat gas market. All right, everybody, that's kind of where we're sitting right now. Hope you enjoyed the session. If you're not a member, I highly encourage you to come in. We're making money. I mean, we're in green year to date this year. I think it's going to get more interesting as we move forward in time. Otherwise, have a really great weekend. Members, I'll see you this Sunday evening. Ciao, folks.